The May employment report coming in much hotter than expected. 339,000 jobs added versus an expectation of 190,000 jobs. The unemployment rate moving up to 3.7%. Joining us right now to talk about what this number might mean for the Fed's next move. Charles Plosser is here. He's the former president and CEO of the Philadelphia Fed. He's now a visiting fellow with Stanford's Hoover Institution. So let's put you back on the board, back in your old job. If you're sitting around the table with Mr. Powell and the rest of the crew, what are you saying to them?
Well, I'm saying this is a pretty remarkably or surprisingly strong employment report. There was some disappointment in the household figures with the unemployment rate ticking up a bit. But it's hard to argue that the labor market is in pretty healthy shape and seems to be very resilient. So I think I would advise lots of caution about the tendency to want to pause or skip a rate increase.
So you're saying hike. Charles, you're saying you'd hike.
I think I'd go for another 25 basis points now, yes.
What about the argument that, by the way, the hiking not really working to some degree?
Well, it's either not working. That's one interpretation, is that we haven't done enough.
Right.
So.
And where do you think Jay Powell's head is on? Now that you have these numbers, is it hike now, take a pause next month, or is it you got to just plan at this point to be hiking for the next couple months?
I would think so. I mean, I think, look, they've barely moved the inflation-adjusted interest rate into positive territory. This is not terribly restrictive at this point. And not only that, the banking turmoil that was so much of concern for the last couple of months has really not materialized. And I think that the danger is that by pausing or skipping a meeting or however they phrase it, the interpretation of the market is going to be they're done. And I think it's a very, very dangerous message to send, or risk of sending that message.
But Charles, in terms of creating instability in the banking business and the banking sector, is there the prospect that if you were to raise or maybe raise too fast, I mean, I think some people thought they were raising too fast, and that's what led to some of this already, that you could topple things?
Well, look, there's always that risk, but I think if it didn't topple in March when all the turmoil started, and it hasn't toppled yet, 25 basis points is not going to make a difference. But it will send a strong signal that the Fed doesn't believe it's done yet. Inflation really has been running between, the PCE core has been between 4.5% and 5% now for a year. And it's not drifting down. And I think they're in danger of sort of losing their credibility.
Look, I've been in the camp that we're going to keep raising and would keep raising the entire time. My question to you, though, is there any benefit to almost a shock and awe raise, which is to say, don't give them 25 basis points, go 50 and see what happens?
Well, I mean, I think there'll be lots of people arguing against that. I wouldn't be opposed to that necessarily. I'd have to think hard about it. But I think that the right message to send is that we're not done yet, and we need to keep moving forward. And I think a good consensus call would be to say, yes, we don't want to raise rates too much, but we need to keep moving forward and get rates up to a more a higher level if we're going to bring inflation under control. So I think 25 would be the right number.